Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Coronado Island. Oh my gosh, look how gorgeous it is. All right, this is the tease part of the video. I'm here at Total Expert Accelerate. There is some military ships and base back there. I'm gonna walk out there and give you a better view. This is the Total Expert Accelerate. So this is where the vendors come in and post up. This is the opening reception, and we have our awesome photographer right here. Let's go. I got here yesterday. Myself and Robin Clayton, who's in charge of digital marketing at PRMG. We were on the customer advisory board, and we had meetings all day from 8 to 4:30 and got a lot done. Total Expert is an enterprise CRM. It's really, really good. Their integrations are amazing, and there's a really good group of people here. And anyway, it's just awesome tech, good group. They're listening to us, trying to be better. We got a bunch of executives from many different areas out here. I'm about to step out here, so bear with me. But I want to talk about, is this what a soft landing looks like? And we're going to find out with some inflation data tomorrow. And, oh, Jesus, not this guy. We gotta do it. What's up, everybody? All right, here we go. So anyway, we got some CPI. That's John Hill. He's our rep and the 3-time salesman of the year for Total Expert, for what it's worth. Every time I'm in, the amazing Sue Woodard. Cheers. You made it to LinkedIn. I actually wanted you on there. John bombed on there. So anyway, love John. Hey guys. All right. So there's this huge section up here. I didn't want to get in the middle of that grinder. Anyway, so CPI is coming out tomorrow. Consumer Price Index. Supposedly a really big drop in the overall number. I think the anticipated number is supposed to be 4.1%. The core is supposed to remain elevated at 5.2%. So is it sticky? Is it staying higher for longer? Remember, the Fed is trying to fight inflation. That's their big battle that they're trying to fight right now. And then the very next day, they come out with the Q&A session and they announce whether they're going to do a rate hike or not. Now, the Fed funds future says that there's going to be 79% chance of no rate hike for this meeting. So we need the Fed to pause. They may do 25, they may pause. The smart money says they're pausing. And then hopefully at their July meeting, they recognize that inflation is still coming down or is on the right path and they don't raise. Now, when will they cut, right? I don't want to look ahead too much, but I think I mentioned on one of my videos, the median time from when the Fed pauses to when they cut is 4 months. So, that could be later this year. We have an affordability problem in this country. I don't know if anybody follows Pat Sherlock. She's great, amazing veteran, sales professional leader. I'm on her newsletter, and I saw something today. It said that the $75,000 income household, it can only afford about 23% of listings out there right now. Rates are high, and higher rates mean higher payments and less affordability, and that's a real problem right now. And in our housing stock, there's less than 1% of all homes that are $200,000 or under, and between $200,000 and $300,000, it's less than 5% of the housing stock. So remember, if rates go down, okay, which would happen after the Fed pauses, or even more likely after the Fed actually cuts rates, then affordability will go up. You can afford more house because the money is cheaper. I'm not trying to look too far ahead, but I do firmly believe that next year will be the 4th largest year on record. The 4th largest year is 2.87 trillion. Okay. As soon as the Fed cuts, or as soon as rates get in the mid fives to low fives, you're going to have almost $3 trillion in first-time home buyer business eligible for refinance. Plus, more people will want to get off the shelf, sell their existing home at the lower rates that they're locked into, because, going up from 3 to 5 or 3 to 5.5 is not a big deal if you want a bigger house. So then you'll get some more supply coming on from existing home sales, existing owners. So we're going to find out tomorrow. CPI is coming out tomorrow, and then the Fed speaks the next day. So really, really big days. Credit card debt. We'll talk about that for a second. Something like, we went from like 864 to like 988 or some number like that. Something like a 17% increase in credit card debt since pre-pandemic. So everyone keeps talking about the credit card debt. That's a sign of consumer weakness. But the amount that consumer credit card debt has gone up since the pandemic, since pre-pandemic, is about the rate of inflation over the last couple of years. People are paying for more expensive goods. It's not like, as a percentage in real terms, if you count the rate of inflation, really credit card debt isn't up that much. Besides, who doesn't use a credit card to pay for everything? Only 10% of America even uses cash as their primary payment. So maybe a soft landing is in the cards. That's a pretty big stat right there. Employment is still, 3.7% unemployment rate. There's some softening there. There's some weakening, but it's not weak. So again, second half of the year is going to be interesting to watch. We'll see what happens in the economy. But tomorrow we're going to get some certainty and some really big data on inflation and from the Fed. I hear jets. If I could see them, I would put them on my camera here for everyone. By the way, I've not had a single cocktail, only a bunch of espressos. And let's all watch out for the Fed tomorrow. Have a good one. Cheers.
Lost you for a second.
How you doing? You're live on LinkedIn. Let's go. Let's go. What's up, brother? Hey, it's KP coming to you live from Santa Monica. Sunset. I think that is Malibu Canyon back there. This is Santa Monica Beach. Got the Annenberg house over here, and that is the Santa Monica Pier, which I can't zoom into it, but there's the Ferris wheel down there. And good folks at Penny Mac were kind enough to host some of their partners this weekend. I was able to sneak away after my last call at 12 and get out and meet them at 1 o'clock. And apologize for not doing my video last night. I was at the Mortgage Innovator Conference. And then update on the house. We had an open house where we were trying to sell that house in Culver City. I'll update that sure in a couple weeks. Gorgeous sailboat. The Fed spoke. I've got an alternative narrative for them. Not a conspiracy theory, just something that they're saying, at least the way I read it. And a little update. So real quick, okay? So the Fed paused. The Fed met and they paused on Wednesday. And they said, not only are they going to pause, but they're going to look at the data. Now, what's interesting is they put in their projections, their dot plot, if you will, that the current rate is 5 to 5.25. So they had 500 basis points from zero. And they always do like this 25 basis point range. So it's 5 to 5.25 is the Fed funds rate. And there's the promenade over there. I'm going to a dinner here in just a second. Let me get one more little view right there. So it's not too bright and shiny. Okay, so they said they thought that they were going to go up to 5.5 or 5.65, kind of the average of all the Fed members saying where they think they're going to go. So if I saw a cop here with a badge, I'd probably walk maybe a little straighter, maybe try not to, do anything wrong, maybe not cuss, not be as loud. Certainly if I was driving, I wouldn't blow through a red light. So the Fed is being the police of, monetary policy. And they're letting everyone know, like, hey, yeah, we paused. We're not done. We're going to raise it some more. We're hawkish. We just want to sit back and, see what happens here with inflation, see if it comes down, see if we meet that target. Now, we all know inflation's coming down. They know it. Now, what's interesting, and by the way, this is really, don't worry, I'm not going to fall off. What's interesting is they didn't just come out and say, we're done. And they want to make sure that the world knows that they're not done. And that way, I don't know. The stock market doesn't believe them. The bondinistas, the 10-year treasury, they don't believe it. So, is this what a soft landing looks like for our economy? I heard Jim Cramer explaining yesterday, this is a no landing. This is not a soft or hard landing. The plates are still spinning in the air, is how he described it. I thought that was pretty interesting. Now, think about this. In this Fed meeting, they said the unemployment rate is only going to be 4.1%. That's down from the last meeting when they said it would be 4.5%. So they're thinking the labor market will be strong. Remember, we talked about the Fed economists in the San Francisco Fed that said that wage inflation only counts for 0.1%. He was pressed in the Q&A, Fed Chairman Jerome Powell, and he said, I don't get into the specifics of papers. So he was kind of ignoring the wage inflation thing. So does he believe the wage inflation is still a problem when, he has a higher PCE target, which is their Fed deflator. That's their inflation number. They have that, I think, at 5.3. I think they're going to have it under 5, closer to 4 by the end of the year. So do you think they're going to raise rates, or are they just threatening that they're going to raise rates? The other thing was the GDP growth. So our economy is consumer spending, which consumer retail sales was up in May, despite lower gas prices. Consumer sentiment came out yesterday, and consumers said they are less worried about inflation. They're still worried about inflation, but less worried about inflation. More soft landing stuff. So in the Fed reports, they put out what they think the GDP is going to be. And remember at the last meeting when they said it was going to be 0.4%, and we're saying like how negative does it have to get the next 2 quarters for the average of the year to be 0.4%? Well, they raised their GDP target in this last meeting to 1%. So they think there's going to be growth, which is less than the standard growth rate of 2%. So they raised growth, lowered unemployment, and raised their guidance for where the max rate is going to be. They think inflation is going to be sticky for higher for longer, but they paused. It's really hard to kind of keep the momentum going and then stop raising and then start raising again. So the bond market doesn't believe them. Most smart money, and it's not like a landslide, but certainly the majority of smart money institutional investors think they're done raising. I do too. Now, how does that affect us? Well, if they're at the next meeting that happens, say 6 weeks from now, and we'll have a lot of Fed speak coming up next week. A lot of people will come out and talk. We'll get the minutes in a couple weeks. We'll really get to dig in there and see. Ooh, homeless person. So we'll see what they really think over the next couple weeks. And, the stock market's been ripping. I mean, it's over 20%. That's a official bull market. S&P, NASDAQ, all the above. They're all rising. Did you miss it? It's okay. I don't know. It's not trying to time the market. It's trying to be, time in the market. So I'm not a financial advisor. I'm not responsible for your losses, only your profits. I hope you've been listening because I've been bullish. But the stock market's ripping. Treasuries are kind of hanging in there because they believe that this landing isn't going to be as hard as they thought. That means less of a recession. And the Fed paused. Now remember, OPEC cut production again, and we have noticed that at the gas pumps. But non-housing services, which is a big part of the PCE services, is still high and sticky, and that's the inflation that they're worried about the most. Although we had an ISM services reading that just came out that was 50.2. It was lower than expected. Under 50 is contractionary. Over 50 on the index means growth. So still slight growth, but less growth and less than was projected. So where are we at? We're at one of the longest days of the year. We're coming up on the summer solstice. Days are still getting longer. And, spring purchase season is still roaring. There's a lot of pent-up demand for borrowers that want to get homes. And by the way, that Kim Kardashian wreck, I don't know if I'm not like a TMC guy, but I think it happened like right over here, one of these stoplights. That stoplight back there. Anyway, I'm not like a fanboy of all that stuff. We're in LA, we're in Santa Monica. It's beautiful. Anyway, so earnings projections were supposed to fall off a cliff, right? Nope. 78% of companies that reported their earnings for Q1 beat earnings estimates. Now, a lot of them lowered guidance a couple months ago or a month ago and then came out and beat the lower guidance. But the stock market has to re-rate that, especially now that Fed funds aren't getting more expensive. So, look, where does that help us in the mortgage business? Rates are in a range. They seem to be somewhat stable. And borrowers, if they can find a damn house, they're going on a contract. So that's where we are. So now let me throw out this is not a conspiracy theory. This is just what I think the Fed really said. The Fed is in charge of making sure that we are funded and that treasuries are sold throughout the world and that we have king dollar. And I know there's a lot of talk about, Brazil, Russia, India, China, and all their currencies. Like the next 3 or 4 to 7 currencies behind our dollar don't even add up to the amount of dollars that are required in the world. And so what we're going to see here, and what I think the Fed was saying with their badge, was when Canada raised their rates and Australia raised their rates, anyone else that wants to compete for those currency investments, you better watch out, because the Fed is willing to put us into more unemployment, a soft recession, and sell our treasuries and make sure our ass doesn't go broke. So that's what they said. It's unpopular to say that. Have a great weekend. Happy Father's Day. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.